What's up everybody, I am Jaspreet Singh and welcome to the Minority Mindset. Just recently, the Federal Reserve increased interest rates again, and you've probably heard people freaking out about this all over the place. Understanding interest rates and how they affect you isn't always intuitive, so in this video, let's go over how it works and how it will affect your wallet and what you should be doing. First, let's start from the beginning. Who is the Federal Reserve? According to the Federal Reserve website, the Federal Reserve is the central banking system of the United States. But the truth is, the Federal Reserve Bank is not a real bank, and it's not a federal or government organization. The Federal Reserve is a completely private entity, and it controls the value of your money and the money supply. Second, what the heck are these interest rates that people keep talking about? When you go and get a loan from the bank, you have to pay interest to the bank, right? Well, sometimes banks need money too. And in this case, there are two different interest rates that you need to know about. One is called the discount rate. If your bank ran out of money and they needed cash, they could call up the Federal Reserve, and the Federal Reserve would give your bank money, and the interest rate that the Federal Reserve charges your bank is called the discount rate. Second is the federal funds rate. Banks are required to keep a certain amount of money in their reserve account every single night. So if one day a bank loans out too much money and they don't have enough money in their reserve account, they need to get that money from somewhere else, and who better to ask for more money than another bank? So Chase can call up Citibank and say, hey, could you give us $1 million for the night so we can meet our reserve requirement? And the interest rate that banks charge each other is called the federal funds rate. So why would Chase call up Citigroup instead of calling the Federal Reserve? Well, the federal funds rate between banks is usually cheaper than the discount rate by the Federal Reserve. So when the Fed increases their rates, the federal fund rates tend to go up as well. Third, so banks are going to charge each other more money. How exactly does that affect my wallet? Well, when banks have to pay more for their money, they're gonna charge you, the consumer, more when you want to borrow money too. So if you go and apply for a new mortgage or a new student loan or a new car loan in the future, it will probably cost you more than it used to. And if you currently have any sort of variable interest debt, like credit card debt or a home equity line of credit, mainly consumer debt type of stuff, then you should expect your monthly payments to go up. The scary thing is that Americans have a record high amount of credit card debt, and so this rate hike is expected to cost consumers an extra $1.6 billion in 2018 alone, according to WalletHub. And that's especially not so good news considering the fact that over 75% of Americans live paycheck to paycheck. Fourth, so does this mean that the world is going to end? Let's put things in perspective. Before the 1980s, the federal funds rate was around 20%. Before the 2008 crash, it was around 5%, and now interest rates went up from 2% to 2.25%. This isn't the first rate hike, and it won't be the last rate hike. There's one more rate hike planned for 2018 and 3 already planned for 2019. We have been living in essentially a 0% interest rate world since the 2008 crash. That's a long time with borrowing money being extremely cheap. The Fed lowered interest rates after the last recession to help stimulate the economy because lower interest rates give businesses easier access to more money that they can use to invest in and grow their business and create more jobs. And lots of consumers like lower interest rates because then money is cheap and then they can go out and finance bigger and nicer things. The tricky part is that raising interest rates is a double-edged sword. On the good side, higher interest rates should mean that your savings account should finally start to pay you something and wages should finally start to go up. But on the flip side, it becomes harder for businesses to grow because borrowing money becomes more expensive and consumer spending also tends to go down because consumer debt becomes more expensive and that hurts growth. And this brings us to point number 5. Understanding the inevitable. Markets are cyclical. There are times where the market goes up, called the bull market, and then there's times where the market goes down, called the bear market. It happens, it has happened, and it will continue to happen. We are currently living in the longest bull market or growth period in the history of time. eventually a recession will happen. If interest rates are near zero and we go into a recession, that would make it nearly impossible to stimulate the economy by lowering interest rates because you can't really lower interest rates past zero. After the 2008 crash, interest rates went from about 5% to 0%, and now we're at about 2.25. So we are in a really weird time. Consumer debt is at an all-time high, partially because interest rates have been so low and people aren't really making enough money to survive. And now on top of all that, payments will be going up. And if you don't increase interest rates and a recession happens, it will make it very difficult to stimulate the economy. So what's gonna happen? Well, only time can tell. These things can take months and sometimes even years to really develop, and we'll be talking more about it on our channel. But the most important thing that you can learn from this is that you need to learn how to manage your money and grow your money and budget your money smartly, because you don't want to get caught up in this whole system and nobody can do it for you. And if you do want to learn more, we have an ebook on money and investing that you can read for free when you sign up for our money and finance newsletter, and you can do that by clicking the link up here and by clicking the link in the description below. Thank you for watching. If you enjoyed our video, hit that thumbs up button and share it with one friend so we can help spread the word. Don't miss our new videos on entrepreneurship, business, and money every Wednesday and Friday at 7:30 a.m. Eastern Standard Time. So hit the subscribe button and the notification bell below. That way you actually find out when our new videos are released. And as always, keep hustling.